If you were born before January 2nd, 1961, the IRS owes you a $6,000 deduction this year, and most seniors are going to walk right past it without ever knowing it existed. It is brand new. It is sitting on a tax form that did not exist 12 months ago. And if you do not claim it on the right line of the right schedule in the right way, you will lose up to $1,320 per person every single year for the next 4 years. I'm Masha, and welcome to TaxWise Seniors. In the next 30 minutes, I am going to show you exactly what this new deduction is, who qualifies for it down to the day you were born, and the 3 steps you need to take right now to make sure you get every dollar you are owed. This is not a rumor. This is not a forwarded email from your cousin. This comes directly from IRS News Release IR-2026-28, published on March 2, 2026, and from IRS Tax Tip 2026-14. I am going to walk you through both. Now stay with me until step 3 of the action plan, because that is where I am going to show you the one mistake that even careful tax-paying seniors are making right now. It is a mistake that has nothing to do with your age, nothing to do with your income, and nothing to do with whether you hired an accountant. It is a paperwork trap, and it is costing married couples up to $2,640 a year. If you have a pen, grab it. If you have your last tax return nearby, even better. Let's begin. Let me tell you about Robert. Robert is 67 years old. He lives in Mesa, Arizona. He worked 34 years as a foreman at a metal fabrication plant, retired in 2023, and now he lives on his Social Security check and a modest pension. Combined, about $52,000 a year. His wife Linda is 66. She worked part-time at a school district until last spring. Robert is the kind of man who does things right. He files his taxes on time, every year, the same week of April. He uses the same software he has used for a decade. He double-checks his numbers. He keeps every receipt in a green folder in the second drawer of his desk. In February of this year, Robert sat down at his kitchen table, opened his tax software, and filed his 2025 return. The software walked him through the standard deduction. It walked him through the extra deduction seniors already get for being over 65. He hit submit. He got a small refund. He felt good. Here is what Robert did not do. He did not scroll down to a brand new section the IRS added this year called Schedule 1A Part 5. He did not check the box for the Enhanced Deduction for seniors created by the One Big Beautiful Bill. Because his software was an older version, it did not automatically prompt him. And because nobody at the IRS sends you a letter saying, "Hey, you forgot a deduction," Robert had no idea. The cost? Robert and Linda both qualified. Both were born before January 2nd, 1961. Both have valid Social Security numbers. They filed jointly. They were entitled to $12,000 in additional deductions. At their tax bracket, that is roughly $2,640 in real tax savings. Gone. Sitting in the U.S. Treasury instead of in Robert and Linda's bank account. The most painful part? It was completely 100% avoidable. One checkbox. One form, one paragraph of instructions. And Robert is not alone. The IRS itself, in the official instructions to the new Schedule 1A, specifically warned that filers were missing this deduction because of confusion over the joint filing rule and the strict birthdate cutoff. This is a brand new deduction. The first filing season for it has been messy, and millions of seniors over 65 are going to leave money on the table this year, unless they go back and check. The good news? Robert still has time to fix it. And so do you. I am going to show you how at the end of this video. But first, you need to understand exactly what this rule says, because the details matter more than you think. Segment 1. What the rule actually is. Here's what the IRS actually says. In News Release IR-2026-28, the agency announced that for tax years 2025 through 2028, taxpayers age 65 or older may claim an additional $6,000 deduction per person, $12,000 if married filing jointly and both spouses qualify. This is on top of the existing additional standard deduction seniors already get. It is claimed on a new schedule called Schedule 1A in Part 5, attached to either Form 1040 or Form 1040-SR. In plain English, that means this. Starting with the tax return you file in 2026, the one covering your 2025 income, there is a brand new tax break just for seniors. It did not exist last year. It is not the same as the old extra standard deduction you already get for being over 65. This is in addition to that. It is $6,000 of your income that the federal government will simply ignore for tax purposes. Now here is the part most people get wrong. It does not matter if you take the standard deduction or if you itemize. You get this deduction either way. A lot of seniors hear new deduction and assume they have to start saving receipts and itemizing. You do not. You just have to be the right age, file the right status, and check the right box. What you should do because of this fact: pull up your 2025 tax return right now. If you already filed, find the PDF copy. Look for a schedule called Schedule 1A. If you do not see one attached, you almost certainly missed this deduction. Segment 2. Who qualifies and who does not? The official rule, straight from the Schedule 1A instructions, says this: to qualify for the enhanced deduction, the taxpayer, and if married filing jointly, the spouse claiming it, must have been born before January 2, 1961. The taxpayer must have a valid Social Security number, and if married, the couple must file a joint return. In plain English, that means 3 boxes have to be checked. Box 1, your birthday, not around 65, not in your mid-60s, born before January 2, 1961. If you were born on January 2, 1961 or later, you do not qualify for the 2025 tax year. You will have to wait until you qualify in a later year. Box 2, a valid Social Security number, not an ITIN, not a tax ID, a Social Security number. Box 3, and this is the one that trips people up the most. If you are married, you must file jointly, not separately. There is also an income limit. The deduction starts to phase out, meaning it shrinks, when your modified adjusted gross income goes above $75,000 if you are single, or $150,000 if you are married filing jointly. Above those numbers, the deduction gets smaller. Far enough above, it disappears entirely. So this is really designed for middle-income retirees, not wealthy retirees, not the very lowest income retirees who already owe no tax, but the great big middle. The folks living on Social Security plus a pension plus maybe a small IRA withdrawal. What you should do because of this fact: write down your date of birth and your filing status on a piece of paper. If you were born before January 2, 1961, and you file as single, head of household, or married filing jointly, you almost certainly qualify. Segment 3, the counterintuitive fact. Most people get wrong. Now here is the part that most people, including financial advisors, get completely wrong. Listen carefully, because this is going to sound backwards. A 64-year-old whose spouse is 67 can still get the full household benefit, but a 66-year-old who files married filing separately gets zero. Nothing. Not a penny. Read that again in your head. Age is not the only thing that matters. Your filing status, the box you check at the very top of your tax return, can be worth more than $2,600 by itself. Here is why. The law says that if you are married and you want this deduction, you must file a joint return with your spouse. If you check the box that says married filing separately, which a lot of seniors do for state tax reasons, or because they are estranged from a spouse, or because one spouse has medical bills they want to keep separate, you are completely shut out of this deduction. The IRS explicitly states this in the Schedule 1A instructions. There is no exception. There is no workaround. Married filing separately equals $0 from this rule. Meanwhile, if only one of you is over 65 and you file jointly, the older spouse still gets their full $6,000 deduction. The younger spouse just does not get one of their own. You are not penalized for being younger. You are penalized for filing the wrong status. In plain English, for thousands of married seniors, the single most profitable tax decision they make this year is not which deductions to claim. It is which box to check at the top of the form. What you should do because of this fact. If you are married and you have been filing separately, talk to a free tax counselor. And I will give you the phone number in just a minute before you file another return. The math on filing jointly may have just changed in your favor by thousands of dollars. Segment 4. What happens if you miss it? The official rule on this is straightforward. If you qualify for this deduction and you do not claim it, the IRS will not add it for you. They do not call. They do not write. They do not adjust your refund upward out of kindness. The deduction is simply forfeited for that tax year, unless you file an amended return. In plain English, that means this: nobody is coming to save you. If you filed your 2025 return without claiming this and you qualified, that money is sitting at the Treasury right now with your name on it. To get it back, you have to file Form 1040-X. That is the amended return form. Within 3 years of the original filing deadline, there is no penalty for missing it, but there is also no second chance after the 3-year window closes. And because this deduction is only authorized for the tax years 2025, 2026, 2027, and 2028, 4 years total, every year you miss is a year you cannot get back after that 3-year clock runs out. What you should do because of this fact: do not assume your software caught it. Do not assume your preparer caught it. Pull up your return, look for Schedule 1A, Part 5, and if it is not there, you have homework to do. Section 5. The 3-step action plan, 1800 to 2500. Here are your 3 steps. Just 3. Write them down. Step 1. Check your 2025 tax return for Schedule 1A, Part 5. Go to your tax software, open last filing season's return, or grab the paper copy you filed. Look through the attached schedules. You are searching for a form titled Schedule 1-A with a section called Part 5, Enhanced Deduction for Seniors. If it is there and there is a dollar amount on it, congratulations, you already claimed it. If it is missing or blank, move on to Step 2. This takes about 5 minutes and it is completely free. Step 2. Call a free tax counselor and ask them to review your return. You do not need to pay a CPA hundreds of dollars for this. You have 2 free options, both run by trained IRS certified volunteers. Option 1. The IRS Tax Counseling for the Elderly Program, also called TCE. The number is 800-906-9887. Option 2. AARP Foundation Tax-Aide. The number is 888-227-7669. That spells 888 AARP now. Both are free. Both specialize in seniors. Tell them, in plain words, I want someone to check whether I qualified for the Enhanced Deduction for Seniors on Schedule 1A, Part 5 of my 2025 return. That sentence alone will tell them exactly what to look at. Most consultations take about 30 minutes. Step 3. If you miss the deduction, file Form 1040-X to amend your return. This is the one most people skip. They find out they missed it, they get frustrated, they tell themselves they will deal with it later, and later never comes. Form 1040-X is the official amended return form. You can file it electronically with most tax software, or your free counselor from Step 2 can help you file it. You have 3 years from the original filing deadline to do this. For your 2025 return, that means you have until April 15th, 2029. But do not wait. If you skip this step, that money, up to $1,320 if you are single, up to $2,640 if you are a qualifying married couple, stays at the Treasury permanently. 3 steps: check, call, amend. That is it. Part A. Engagement. Ask. Before you leave, I want you to do 2 things for me. First, drop a comment below and tell me, did you already know about this new deduction, yes or no? Just 1 word is fine. I read every single comment on this channel and I reply to as many as I possibly can. I want to know how many of you were caught off guard by this, because that helps me know what to cover next. And second, If you have a parent, a sibling, a neighbor, a friend at church, anyone you know who is over 65 and files a tax return, please share this video with them right now. One share could put up to $2,640 back into a senior's pocket this year. That is real money. That is grocery money. That is heating bill money. That share button is right below this video. Use it. Part B, subscribe, ask. If you are not subscribed to TaxWise Seniors yet, please hit that subscribe button right now and turn on the notification bell. I post new videos every Tuesday and every Friday, breaking down exactly these kinds of rules. The rules that change quietly, the deductions that get buried in news releases, the deadlines that nobody tells you about. The tax code changes constantly, and you deserve a channel that watches it for you. Part C, next video hook. In my very next video, I am covering something even more urgent, the Social Security earnings test, and the one mistake that can cause the SSA to withhold 100% of your monthly check, even if you only earned $1 over the limit. That rule affects more than 4 million working seniors, and most of them have never even heard the words earnings test. Click right here to watch it next. I'm Masha. This is TaxWise Seniors. Take care of yourself, take care of your money, and I will see you in the next video.